Zimbabwe cash crisis worse. About Venezuela once again. Systemic important banks. They removed the 1,000 thing called monetary Hey there, hope all is well. Back at you today with some more RT News updates. And as you can tell from today's title, we're going to be talking about the idea that the next recession could wipe away a good portion of your net worth, according to a report from the IMF, that they gave us a very modest number being erased from the net worth of American household families. But yet, based upon history and some information I'm going to share with you today, I believe that's just the beginning of what could be underway when this next recession is in full bloom. And so, as always, before I dive into today's articles, more importantly, take the time for yourself to thumb through some of these articles and familiarize yourself with what history has shown us so that it can help us better prepare for the future. And so, before I dive into the articles, as always,
It's the next recession.
Recession will be.
Will be a recession.
We're going to hit a recession.
The date of the next recession.
A U.S.-only recession typically lasts 8 to 10 months.
A crash is coming. Now, whether it's 6 months from now, 12 months, 36 months, no one knows.
If you have the right plan to set up, you can make a lot of money from this.
So as I mentioned, I have a couple articles I want to share with you, but more importantly, I can never stress enough how important this subject matter is. And so everyone's talking about it. More economists are coming out talking about a recession. But what's really funny and worth noting is the fact that they keep throwing out the time frame 2020 as if there's some type of magic window or magic formula that can predict an actual year. And so if you've been a follower of Everything in a Dollar, I talk about how it could come out of nowhere. And more importantly, it'll probably be sooner than expected, given the fact that they are warning us of a future date to calm the nerve of investors to keep the markets from going haywires. But more importantly, it's very interesting as to how the IMF is now coming out, sharing with us an actual nominal number that they think could be at a very bare minimum, where if you look at history based upon the last Great Recession, it was almost 3 or 4 times that amount that the IMF gave us in this most recent report. And so as always, take time, scroll down below, find out more for yourself. And more importantly, if you find this informative, which I definitely know it is, give it a thumbs up and feel free to share this with your family and friends so they can become more aware of what's at stake and what they consider to be their net worth. So let's dive into the very first article. So here's the very first article here that I want to share with you, which gives a summary of the IMF report that came out as of yesterday. And it's from France 24, but it says trillions in U.S. net worth vulnerable to recession, says the IMF. And so I'm going to thumb through and give you an idea what's on the surface, but more importantly, get to the nuts and bolts of it. But it says a severe recession would slash U.S. wealth by about $5 trillion, causing vastly more damage to Washington's finances than just an increase in debt and deficits, the IMF warned as of yesterday. It says, yet governments around the world, many of which face similar dangers, do not clearly publicize their overall net worth, the IMF said in the report. And so if you scroll through here, it gives more information as to what the actual assets and liabilities of governments are. But when you scroll down to the bottom, it talks about what is most important to you. And it says Wall Street, pensions, and debt. It says, meanwhile, the net worth of the United States has been in a decline for nearly 4 decades, worsening notably due to the global financial crisis, referring back to 2008. It says it had sunken by 2016 to a negative 17% as a share of GDP, the report said. It says, but the biggest source of risk comes from state and local government retirement pensions, which can lose money when Wall Street sinks. It says, meaning the shortfall has to come out of local government budgets, which means more deficit. Towns and states that have to cut spending elsewhere, creating a drag on the economy. So towns and states, meaning less government employment, higher unemployment numbers. Since nationwide, such pension funds are already underfunded by about 8% of GDP. The IMF found that a severe recession would cut the value of America's publicly held assets by an amount equal to 26% of GDP by 2020. So here we have the idea that publicly held assets will be cut by 26%, and here's this time frame, 2020. And so it looks like they have all agreed to give us an ideal time frame of 2020. Should make you wonder. It says the scenario, which imagines a deep global recession, rising interest rates, but collapsing stock and real estate prices, would see sovereign debt balloon by 9%, but net worth die by another 17%, mainly because falling real estate prices would drag down the value of publicly owned structure. So here we have a good idea of what some of the very bare minimum might be, which is a 17% decline in net worth, including stocks, real estate, and things of that nature. So keep that in mind as we keep moving forward. Next article here, as of yesterday from Forbes, says the next recession could happen sooner than we think. So here we have another warning sign from another economist. So as you scroll down here, it gives you an idea as to how the last recession played out. And then here he gives some of his measurements as to how it's not until 2020 that we should then expect another recession. So the first indicator here says changes in the Conference Board's leading economic index captures the pulse of the business cycle. And then the second one, shrinking spread between the 10-year and 3-month Treasury rate, particularly when it turns negative or inverts. And then finally, it says tracking how far the Federal Reserve of the United States fund rate is above or below the neutral rate. So these are the three measurements that this gentleman here is using. And according to him, it says, given the current levels of LEI, the yield curve slope, the Fed stance, it looks like the next recession won't hit until well into 2020. So once again, we have a gentleman giving us his projected time frame of 2020. So it looks like everyone is in agreement around the world that 2020 is a date that they're told to give the public. So basically, if the year that's being given is 2020, I would expect it to be a lot sooner. So something worth considering, but more information below if you're interested in reading for yourself. So the very next article came out today. It says when the next recession hits. It says the government has less flexibility to address a financial crisis than it did during the last one. So if you go through this one, it's quite long, but it talks about how we arrived at the last recession and the steps that was taken to resolve that matter or to paper over it. And it has to do with bailouts. So the argument in this article here is the fact that the primary response of government and the Treasury and the central bank was to agree upon bailing out the banks. They was too big to fail. So it poses a question as to what will happen during the next crisis if they try to use the same formula that they came up with as a last-minute measure to save the banks. It says it's possible that the Treasury and the Fed won't need such flexibility in the future. And then it gives you an idea as to how that could be. It says in 2010, Dodd-Frank laws requires U.S. banks to give regulators living will plans to dismember themselves in times of collapse. So it also created an, quote, orderly liquidation authority, which is supposed to provide a process to liquidate, say, if Goldman Sachs went under, who would be responsible. And it says basically shareholders and creditors rather than taxpayers. But if you actually look at it, who are the taxpayers? They are the shareholders and the creditors. And if you happen to bank at Goldman Sachs or any other too big to fail banks, you are considered an unsecured creditor. So you are the one that will be bailed in, unfortunately. So it says, but there's a real disagreement as to how orderly the process would be if multiple banks were falling all at once. It says the next crisis might unfold in ways the new rules and regulations haven't anticipated. In any event, stopping a run probably would require taxpayer money. It is just about the only thing that has stopped bank runs since the 19th century. So that's just a little insight as to what could happen in the banking sector. Next article here came out on Monday, and it says the last time unemployment was this low, we were hit with the recession. And so it says the last time unemployment rate was lower than 3.7% came in December 1969 when it hit 3.5%. Shortly after hitting that level, the economy tipped into one of the mildest recessions the U.S. has ever seen. Some experts worry that the economy could overheat and the Fed could help hasten a downturn by raising interest rates continuously. So that alone lets you know that here's another indicator that they say could be a cause of the recession. And I'm sure if you read through it, they'll probably throw out the numbers 2020 as if that's baked into the cake or part of their script. So more information if you're interested in reading for yourself. So here's an older article that I think is worth mentioning, the fact that this is what happened after the Great Recession, and you're able to look back and get an idea as to how catastrophic it was to the overall economy and the net worth of individuals. And so it says here, the average American household lost a third of its net worth during the recession. 1/3. Says a new study shows how much exactly the 2008 recession contributed to rising inequality in America. So this was as of 2014. We're 4 years later, and we're supposed to be in an economic expansion, but we'll see how that turns out. It says in a run-up to the collapse of the housing bubble in 2008, average American families saw their net worth climb, partly because of the bubble itself. It says, but by 2009, says a recent study by social scientists, everyone was a loser. It says housing prices in the largest cities lost a third of their value, the stock market nearly collapsed, and unemployment doubled. Yet, as New York Times points out, the story of the recession isn't necessarily one of loss so much as it is increasing income equality. So based upon looking back at what happened with the recession 4 or 5 years afterwards, A third of net worth was lost, including stocks losing its value, housing losing its value, as well as massive unemployment. And so the idea that 1/3 of net worth was lost is just the beginning of how much wealth was lost in total. So the very next article here from NPR was also 2013 timeframe. It says all the wealth we lost and regained since the recession started. And give you an idea, it says American household lost roughly 16 trillion in net worth since the recession started in 2007. According to the latest Fed data, it says we regained about 14.6 trillion, roughly 91% of it. But let's not break out the champagne glasses just yet. It says a new report from the St. Louis Fed shows that after adjusting those numbers for inflation and normalizing them for population growth, we recovered less than half of what we lost in wealth. So basically what the data is saying that approximately 4 or 5 years later, half of that net worth that was lost was regained when they began the QE process, inflating artificially the housing market as well as the stock market. And here we are 5 years after the fact at all-time highs in housing prices, student loan debt, stock market valuations, you name it. So this leads to the very next article and idea. This is what's at stake of your net worth. This is one of other articles that gives a grand total of what is at stake come this next recession, given the fact the IMF says that only 5 trillion, roughly at a very low ballpark figure, could be lost in net worth. And then if you look back based upon what has happened, 16 trillion was lost, but then it was regained through artificially inflating the stock market as well as the housing market as we're currently in now. But here we have the US retirement assets at 28 trillion in Q1 of last year. So since that time frame, around 2010 or so, trillions of dollars have been flooded into the retirement markets, causing it to reach all-time highs of savings of $28 trillion in a variety of financial vehicles, everything from defined contributions, government plans, IRAs, 401ks, you name it. And so here we have basically in 2000, it was a very small portion of total retirement savings, and now it's at an all-time high. And this all-time high is what is most at stake, given the fact that a lot of people don't know what they're invested in. And all this, for the most part, is tied into the strength and the continual increase of the stock market. So within 20 years and recent changes as of 2006 to the retirement process, more people have been driven into these target mutual fund assets here, which for the most part are ran by computer algorithms that target an ideal time frame for you to retire. So definitely things worth considering at what's at stake in this next recession. So more information if you're interested in reading about it. So the very last article here is from Bloomberg, and it says U.S. household wealth hits record 106.9 trillion as of last quarter. So to give you an idea what this is talking about, it says U.S. household wealth rose by 2.19 trillion to a fresh high in the second quarter, boosted by a stock market rally and higher property values. So here we have 106.9 when you combine the 28 trillion retirement vehicles and the rest of that, which is about 70 trillion in real estate. Here we have $106.9 trillion, which makes up the net worth of every American in this country, give or take, according to whatever it is you're holding on to. But this is what's at stake at the end of the day. So the fact that the IMF says that roughly 5 trillion could be wiped away, imagine half of this being wiped away. How would that impact the future of every demographic in this country, whether it be the baby boomers that are a draw from the stock market or the younger generations being told to put into the stock market, as all the financial markets are completely inflated beyond belief into bubble status territory? And so the fact that the IMF is giving warning once again, and they're throwing out a bogus time frame of the year 2020, lets me know that there's a lot more at stake than most people are really aware of. So based upon history, 16 trillion was reportedly lost last time. Imagine how much more it could be come this next recession. And so according to history, every recession tends to get worse because there's a greater expansion of debt and more pressure placed on the public because more people are tapped out of disposable income. So the very thought alone of losing half of this or a third of this should be frightening to a lot of people. But more importantly, if you're made aware, it'll make it easier to brace for impact as all this stuff unfolds. So, and more importantly, if you have any skin in the game in reference to this 106.9 trillion, how much could you afford to lose if things do come crumbling down? So looking forward to find out your comments down below. Look forward to bringing more news updates.